A very good afternoon to all of you. And my name is JP Sinha. I currently run a company called Neobel, which is into loan against securities business. But otherwise, I have almost 25 years plus experience in capital markets, banking, mutual funds, a lot also on the technology side. Uh, so by qualification, I am a finance guy. Uh, Mostly spend time in dealing with finance, valuation, research, investments. So used to be a fund manager with SBI Mutual Fund way back in 2001 to 2003. Set up a lot of broking houses in terms of research practices, including Kotak PCG Desk, Ambit Capital, Quant Broking's fundamental side of research. So, and in terms of education, I am master's in physics and then PGDM, which is MBA from IIM Bangalore. I'm also a CFA charter holder. So hopefully this session you will enjoy. That's the idea. So I've kept it very simple. In fact, let me share my screen. I have a small presentation which will help me to stay on the course. I hope the screen is visible to you.
Yes, sir, it's
So,
visible.
okay.
Yeah.
So this education webinar, the topic is the silent edge, the hidden formula for outsized wealth. Now, all of us who are investor, who wants to invest in the stock market, in the capital market, be it equities, bonds, even in the personal life, like buying a flat, buying gold, buying any other buying decision or investing decision that we do in order to enhance our wealth, we generally know that we are buying a stock or any idea or any instrument where it gives me some returns which are not just meeting my expectation, but slightly over giving me extra return as well. Now we all know the very basics, and let me tell you, basics don't change. So some of the things that you will hear from me are repetitive in nature, but then I'm sure there are few things which are where I will add some more value. So if you see that, discover the quiet principles that separate the truly wealthy from those chasing quick fixes. In fact, just let me tell you, in between post-COVID, actually, the number of retail investors have risen sharply, and we all know that. And a lot of them have gone into the F&O markets. And we know the result also, which SEBI came out with white paper, where 9 out of 10 traders, the F&O players, were losing money. Why? Because they were chasing quick fixes, right? We'll discuss more into detail. And I am also told the structure of the presentation should be that the first 45 minutes I'll be walking you through, and then next 15 minutes you will have the question answers. Just a quick thing, I am not able to see who all are there, and just 1 second. So if somebody wants to raise hand or anything, I don't know whether I'll be able to see it immediately, but I'll try. Okay, so first, the slide says wealth whispers, not shouts. Now, this is very, very important one. Uh, in fact, those of you who understands Hindi, there's a old saying that adjal gagri chalkat jaye, bhari gagariya chupke jaye. So the pot which is filled with water doesn't spill, but the pot which is half filled or less filled, it keeps on going here and there while carrying. So true wealth is built quietly through discipline, patience, and time. These are the three most important ingredients: discipline, patience, and time. Anyone who is promising you super normal returns, right? So if you see the next one, it says loud get rich quick schemes often mask hidden risks. So there's no free lunch. We all know that there's no free lunch. So if somebody tells you that instead of 12 or 13%, you'll get a 24 or 36%, you should know that it comes with its own risks. Sometimes the risks is of return on capital, and more often than not, the risk return of capital. So whatever the principal that you are investing, that is also on the risk, right? Focus on fundamentals. The silent approach is very boring, extremely boring, because you have to do the repetitive work again and again and again. So we say in our investments that investment is very boring. Trading is very, very exciting because you know the result immediately. You can get in, you can get out. But as I said, chances of making a loss if you are a retail investor is way too high for various reasons, and we'll come to those reasons. The third thing is avoiding traps. When you are investing, and as we mentioned, the discipline, patience, and time are three key ingredients. The converse of that is emotions. When you bring your emotions into the investments, when you have hope, I'll come to the hope in a bit when we talk about some other pitfalls. Anxiety, you have invested 100 rupees and market has fallen. It has given you a loss of 10% and you are anxious. Fear of missing out. Somebody has bought a stock, it has doubled, he has come and told you, now you are feeling that you have missed out and now you are desperate to get in. So whatever comes first, I will take it. Fear of failure. Now there's other side of fear of missing out is fear of failure. So I'm not investing because of fear of failure. Now that is the biggest risk. The biggest risk is when you don't take risk. Impulsive decisions. Many a time your emotions take better of you and you take impulsive decisions. And I'll give you examples and many more things of this. But let me tell you some stories first. So those of you who have read the book called The Richest Man in Babylon would know who is Arkad. Now, Arkad was nothing but a record keeper. And like all his friends, he was also earning a very meager sum, which was equivalent to a laborer. However, this I'm talking about a story which is almost 5,000 years back. So in Mesopotamia, this place was called Babylon. And because of its strategic geographical location, a lot of tourists and traders used to pass through Babylon. And this is a story from that Babylon. So this Arkad, who was also earning a very modest sum, was the richest man over a period of time. Obviously, he became the richest man in Babylon. And he used to lend all the traders, even to the king. Now, what has happened? So, what happened with Arkad? I'm sure those who have read this, so it's a very small book. You can finish it in one session. So what it talks about, and we'll come to that. But this was a one guy who, if you see here, what we have written is unwavering discipline and wisdom. So his wisdom is even valid even today, right? And he transformed his financial destiny one coin at a time. See, he was not a big earner, but he was a big saver. So he had a principle that anything I earn, first I will save and invest, obviously. So the story goes like this. Arkad's friend, who were equally the hard workers, they one day reached out to Arkad asking that you are one of us. You also earn the same amount of money that we earn. But how come you have no financial struggle while we all have? Right? So he came to ask their wisdom. We all know Rakesh Junjunwala, the big bull of India. He was always optimist about India's growth story. We all know that he started with a meager sum. There's also news which keep on circulating that he made big money in trading. Uh, we'll come to that later part, but the trading income would be minuscule compared to his investment income. So if he has made 40,000 crore worth of fortune in investments, trading income would be not even 5% of it. And philosophy was very simple: buy right and sit tight. Again, patience, time, and discipline. The other thing that he championed actually in is taking contrarian bets. When people were very uh, skeptical of a company, good company, thinking about it is already overvalued, it has already got its run of its period is prime, it is prime past now. That is the time he used to take those contrarian bets, right? Then we also heard about Mr. Damani, rather R.K. Damani, and we all know because of his DMart. But otherwise, besides DMart, also he has a large portfolio. Being a broker, he is someone who understood the market, who understood the companies, and spent a real long time to build his wealth. Now, obviously, from an investor, he has also become an entrepreneur. And taking cues from the investment, understanding that what helps build wealth, he guided his uh, DMart in a market which was actually collapsing. So if you guys go back and think about the retail market at that point in time, we had uh, Kishore Biani's Pantaloon Big Bazaar, which failed. We had a couple of other retailers, Pantaloon, then there was a couple of more. None of them reached where DMart has reached. And also finding out a niche where to operate into. Now, these all require a lot of thinking, lot of strategizing, how to operate, what model to operate, all those things. We have heard about Mr. Motilal Oswal, who is the founder of financial services company called Motilal Oswal Financial Services. Now, if you look at him, he is a champion of research. So even today, Motilal Oswal's equity research is considered to be one of the best in the industry. If you leave aside some of the foreign firms, uh, among the domestic firms, it is one of the best. Now, again, here also, if you, and they come out with something called wealth creation reports. Year after year, they have come out with wealth creation reports, and they have talked about uh, which type of companies, what are the characteristics of these companies, which generates wealth over a longer period of time. Now, again, if you look at these wealth reports, it mostly talked about investments, goes back to core fundamental values. So it will talk about what is the return on equity, return on capital employed, how is the valuation, what are the growth, what are the unique advantage the company has, how it positions itself in terms of branding, in terms of supply chain management, distribution, manpower, everything. There is another examples which I thought I'll bring in. So, gentleman Maurice Chang, he was an employee uh, in a semiconductor business. He was a science graduate and was basically an employee, and he used to uh, save from his income. And from that income, he founded, after retirement, when he came back, became a government advisor. He started this company called Taiwan Semiconductor at the age of 56. Now, from that period, we know that this company is now a multi-billionaire. And his story is talked about. His story is talked about in the investment world, that how somebody has changed the way uh, companies can be built, investments can be made, and from the smaller amount. So stories are endless. In fact, you will add another 10 or 15 stories into it. So the question is, what makes them different, right? Now, there are few things. We sometimes we know it, sometimes we ignore it, sometimes we try to pass it over as boring, but they remains where they are, right? So the lessons that we learned from Babylon is, so Arcad, remember the Arcad. So what it says is that whatever I earn, I will save it first, and that is consistent. The second thing he said, I will not unnecessarily increase my spending. So if my income has gone up, so typically in India, middle class story, if you hear, as the income goes up, the expenditure also goes up. Now, this gentleman, Arcad, what he did is he never went beyond his means. I mean, not even beyond his means, but he never changed his lifestyle. So he still used to stay in the same house which he was. He still used to contain his cost, and whatever he was saving, he was spending. So in those days, it is more of money. The money was seen in the forms of gold. So everything, the entire story is how you invest gold, how one gold become two gold, and etc. But what he also looked at, besides these two, is how to protect his wealth. Now, while he was lending, he was not lending uh, to anyone and sundry, not even to his friends. So he was very cognizant of the fact that money should be paid back with interest. So he was very cognizant how to ring fence his gold, right? And every time, whatever he used to earn, he used to again reinvest. That accelerated the entire growth. So we all know that the first crore, making of first crore is very difficult, but making of second crore is easy and in less time. Third, even less time. And so if you go back to uh, even the best of the investor, which we all know, Warren Buffett, the first billion came when he was almost like 60. And today we know what the story is. Similarly, from lessons from the three gentlemen which I talked about, and there are many of them. It's not just these three. These three I have taken as a representative. So it comes patience and research, strong fundamentals. What these guys actually did is taking a bold step. Most of us, even if we are right in picking a stock, we will take a very, we will invest a very small sum. That brings us the asset allocation. We will come to that part in a bit. But what happens if you have found a very good stock and you have invested only, let's say, one share into it, even if it becomes 10x in 20 years or 10 years, it hardly makes any difference. So that is the another thing, that you have to take some bold steps when the conviction is high, and conviction will come high when you do research, when you understand the subject, right? So if you see here what Junjunwala used to say, invest in what you understand and never get emotional. From Chang, we understand it is patience and never too late. In fact, a lot of my friends, because now I'm 50 plus, a lot of my friends come to me and saying that, you know what, we have always kept our money in fixed deposit. And you tell me that 10, 15, 12%, 12, 15% is the return. So in that case, now we don't have much of time left to us. And I keep telling them there's never too late to start. There's never too late to start. So, in fact, there's a very saying that you are sitting in a shade of a tree because somebody has planted it. So maybe you may not get that benefit today, but some other time. And that some other time, maybe your kids, or maybe sometimes you live longer. That is also true. Correct? So the discussion is incomplete unless we talk about Warren Buffett. So he always championed on undervalued quality companies. So value investing was very, very critical for him. Very, very critical. So he used to find values which were much less, the price which were much less than the value, intrinsic value. And intrinsic value in 9 out of 10 cases were only and only because of when you do DCF calculation, where you find out what is the cash flows, right? And needless to say, this patience has given him 20% annualized returns over 50 years. So coming to the differentiators, the first and foremost is compounding. Now, we all have heard about it. We all understand how it works. We all know how to calculate on Excel or calculator. But unfortunately, we don't get the benefit. And the reason is simple, because if it takes 7 years to show the compounding benefits at a much larger scale, the amplified scale, our patience runs out before that 7 years. Why I'm saying 7 years is, suppose you are even in let's say PPF, you are investing, and that gives you a fixed return of 8%. After seventh year, the investment that you make 1.5 lakh, the interest will be more than 1.5 lakh. But that comes after seventh year. That magic that your whatever you are contributing, the income is more than the contribution. So it gets doubled now. After 7 years, again it gets quadrupled. But we don't see that. We don't let it work. So what happens? Because we need money, we keep on taking out our investments before it gives me the compounding benefit. In fact, compounding benefit works like this. It rises very slow and then it scales very fast. But if you keep on taking money, so it will go up, then come down, then again it will start from zero, come down, again it will start from zero. So you leave with a large gap. So in 20 years, what you thought will become 25x is actually only 2x, right? So it is the time. It is the time and that. So just to give you some examples of compounding. So in India, if you I will give you just a number. So Nifty was 3 digits in 2001. So let's say 1,000. 1,000 has become 25,000. So in 25 years, Nifty has given a 25x returns. Now, how many of us has got that? You may have very few people, right? Berkshire, $1,000, anyone who has invested in 1965 with Warren Buffett would have become 27 million, right? Junjunwala has got 100x because he started with small sum into a very early stage. So compounding rewards patience and reinvestment over decades, not over months. unfortunately, to become to get quick rich, we try to see that whether it can happen in months. And I'll come to those examples. How do people think that it should happen in days or months, and how they fail? But it's long time. It's over a very long period. And those who actually have the patience, they know what it gives. The second is discipline. So I call it the unseen muscle of wealth, the discipline. So when you try to adhere to a discipline, you have some rules made for yourself and try to adhere to it. In the short term, you have always the pain. It's not easy to follow discipline. I mean, to get up at 5:30 and go for a walk is not an easy task, right? And all of us do New Year resolution and knowing that on the fifth or sixth date it will fall. So discipline is difficult to manage. And what it basically means is sticking to your plan, even when it feels wrong or boring. But then this is the difference between wealth and wishful thinking. So I have a wishful thinking that I should have a very good body, but without taking pain of going to the gym. So that is a wishful thinking. So discipline is the another core of it. Time, I will keep repeating time, time and again, that it is the time which will give you the compounding benefits, which will ride through ups and downs. See, there is a slide for that also, but you have to understand that whenever we invest, it comes with little extra risk compared to a fixed deposit or bond. So whenever these happen, whenever there is a excess return expectation, we have to understand that it comes with an additional risk. But time is one of the biggest healer, and these fluctuations so keep on diminishing. So if I look at the 1 year there is a high volatility of returns. Second year the volatility is less. Third year it comes even less. Fourth year even less. And as I again said, the number seven, the seventh year, typically in the Indian market, empirically, we have seen no negative returns and very less volatility. So you come back to the volatility of 17 to 18%. When I say volatility, I'm talking about standard deviation. Right? Okay. But then all of us make mistakes. So while the virtues are just the three, which is compounding, discipline, and time. However, the mistakes are make many. And I'm saying this because personally I have experienced many of them. And sometimes it feels that I'm doing it right. But then once time passes, then you realize that these are the mistakes that we made. So first and foremost mistake is the lottery mindset. Now, I'll tell you a very simple example of that. So taking from cue from a book called Thinking Fast and Slow, and I'm sure you must have heard about it. Uh, this Nobel laureate talks about why people buy lottery tickets. They keep buying lottery tickets because the initial investments of is very small. So let's say $1, or in Indian parlance, let's say 100 rupees. And the expectation of return is 1 crore. Now, we all know the probability of winning that 1 crore is way too less. But because that 100 rupees seems too small, you don't mind letting it go also. But what happens, and and they have given research and proofs that over a period of time, you have actually spent on lottery tickets way too high a number, which otherwise could have been a big wealth. And the worst part is the lower the low you are in the income bracket, there is a high propensity to buy lottery tickets. The same thing, exactly same things we have observed in Indian parlance, where a lot of young traders, without having much of understanding of market, entered into F&O segment thinking they will have a big lottery. Because what happens when you get into options, the option premium is only 1 rupee, 2 rupees, or even less than 1 rupee, 2 rupees. So what you think that even if the stock price goes up by 5 rupees, my 1 rupee will become 6 rupees. So there is a 500% gain. But as I told you that our SEBI's white paper suggested that 9 out of 10 invest traders have lost big time money. Same goes with casino, where you try to make it big, but ultimately we know that house wins. Maybe there will be a random situation, random cases where somebody is the winner, because lottery there is somebody is a winner, but that is a very random. That is very random. It could be you, but the probability of you is, as I told you, is way too small. Way too small. Right? So this false hope is something which destroys wealth much more than building it. And the lottery mindset gives you a false hope. Psychology trap. So I talked about anxiety. I talked about uh, lack of discipline. I talked about uh, getting emotional, impulsive. These are all my psychology trap. Most of the time, when I am anxious, when I am into this kind of situation, I make a wrong choice. And that becomes a very costly wrong choice. Even though I invested in a company which I thought is a good company, but because of external factors, the stock price has gone down by 50%. Now, this has created panic into me. So, how do I get out of that trap? Leverage is another such trap, right? Third is our biases. We are very overconfident. If we have invested in something, we become very overconfident that this company is the only company in the segment, right? Loss aversion. I mean, we don't want to cut losses. So we keep on hoping that the stock will come back to its original price, at least the price where I invested in. So 100 has become 80. Now I'm hoping that once it becomes 800, I will sell. So I'm constantly thinking that okay, let it come to 100, let it come to 100. But if it's a bad company, then 80 will become 70, 70 will become 60. Right? So here, this I talked about the book Fast and Thinking Fast and Slow, Thinking Slow and Fast. Now, what it says is when you do a fast thinking, you are impulsive because whatever information you are getting, you are just processing it and taking a decision. That is wrong. That is wrong when you are investing. That's why I said it is very boring. You have to process the information, react to market volatility with fear, prone to overconfidence and shortcuts. So whenever you are thinking very fast, I mean, you are taking an information, immediately processing because it is based on your biases. If the reaction that you comes, it is based on your biases, and then in that is very prone to taking wrong decisions. But slow thinking, where you are now processing the data, you are trying to understand why it happens, what it happened. Then you take a very deliberate action. So you consider risks and probabilities more carefully. And then you say, okay, whether it is a fact or it's a noise. In the fast thinking, fact and noise are both merged, difficult to disintegrate. In second case, you disintegrate fact and noise. Last is present bias, overvaluing immediate rewards, right? Market volatility. See, equity market by nature, commodities market by nature, bond market by nature, they are volatile. They are volatile. If somebody is not able to understand what volatility means, volatility is risk. Many people see this risk as an opportunity. And those who see risk as an opportunity, they make gains. But those who see risk as a risk and are fearful of that, they are the losers. So we have to understand that market volatility is a routine. How do I get benefit out of it? So if I have a long-term vision, I will sail through this market volatility. So as I was mentioning that in the 7-year market volatility becomes lowest. And after that, obviously it remains in that range. But your income, at least empirically in Indian market, if you have invested more than 7 years, your return is positive and commensurate. Feeling of missed out, FOMO, right? Somebody is telling me, my friend is telling me that these are the investments that I made and I made killing in that. Now I start feeling that, oh, I missed this opportunity. Let me tell you, every legion missed out, right? So Buffett missed Google and Amazon early. Very recently, I mean, last 3, 4 years, he has started investing in Apple, right? So don't why not missed opportunity? There are many opportunities which will be there. So what is important is I have a plan, I have an objective, I have a strategy. Am I moving in that direction? If my strategies are clear, these missed out opportunities will not disturb me. Leverage. All these FNO trades or margin trading or intraday, these are all leverage trades where you are putting 10 rupees and the broker is giving you some either advance in margin trading, or because of the margin guidelines, you get 3x, 4x kind of leverage. Now, while it amplifies gains, but if you have got on the wrong side of the sword, then your capital is also wiped out. Right? So I don't have to go into the 2008 housing crisis, but these are the things. I'm keeping an eye on the watch also because I realized it's already 5:40. Some of the other pitfalls is chasing past return. I mean, you must have heard about disclaimer that past return is no guarantee of future returns. But we still look at that. We still drive ahead with a view on the rear view mirror, which is wrong. Too much of trading, lack of diversification in my asset, emotional reactions, forgetting to rebalance as we go ahead. And lastly, I will talk about the most important point, which is the bubbles. So we have many bubbles in the market, many. I mean, in fact, there's a good book called Bubbles, Panics and Manias. Uh, what it talks about is people get carried away in the bubbles. They get carried away by the frenzy which the bubbles brings in or the manias brings in, and which obviously becomes the bubbles. So we have heard about tulip case, we have heard about Mississippi bubble, we have heard about, this is the biggest one, US Nifty 50, right? It is not in our Nifty 50, it is the group of 50 stocks which were considered to be most stable, most regular dividend paying stocks, and the entire US was investing in those companies, and that fell by almost, I mean, they crashed, not fell, they crashed. And that led to a biggest recession. Dot-com bubble, we have heard. But what is the pattern with that talks about bubbles is rational optimism. We initial legitimate reasons for price increases. So initially, yes, there was a legitimate reason, but then it keeps on growing without having the base. So if you don't have a cash flow, just because the story looks good doesn't mean that a company is good. The second is credit expansion. In fact, this book talks about credit expansion in detail. And what it talks about, that whenever there's a low interest rate and easy liquidity available, people borrow and invest. And this has led tulip mania also, the Nifty 50 crash also in US, the dot-com bubble also, and the recent bubbles also. So while low interest rate looks good, but if the low interest rate started, I mean that money is started getting channeled into capital market, then there is a problem. In fact, uh, if you see, SEBI is extremely worried that why the FNO trades have gone up. And you'll be surprised to know there are many individuals who are borrowing personal loans and investing in FNOs. And lastly, fear of missing out, right? So pushing valuations beyond all reason. And every time, you'll know what? Every time the story is there is something new here, right? This time it's different. This time it is different. Unfortunately, as a fundamental analyst, as a fundamental somebody who looks at fundamentals, I can tell you there is no replacement to cash flows. If my cash flow is not justifying, maybe I can go a little bit extra here and there, but ultimately there has to be substance. There has to be substance. So if you see that people are telling you this is different, then you have to be cautious. So coming back to uh, last segment. So equities returns, as I keep telling, this is the thing that you should not miss out. And when I say, I don't mean that put all your eggs into equity, because that is also incorrect. But you have to be cognizable where the returns can be made. So, but also you have to keep in mind these returns come with high risk as well. So higher the risk, higher the return, and vice versa. You have, so as I was mentioning, don't put all your eggs in one basket. So the second important, so first parameter is equity gives you higher return. So please invest. The second is be cognizant of asset allocation because it brings two things. One, diversification. So you're not putting all your eggs in one basket. So it reduces volatility. The mix of assets reduces volatility. So if you see on the bottom right, stocks gives you growth and income. Bonds give you stability and predictable returns. Real estate gives you tangible assets, rental income, inflation hedge. Commodities also gives you diversification and inflation hedge, right? However, this allocation has to be kept in mind. Keeping strategic allocation aligns investment with your risk tolerance. So it has to meet with your objective, your goals, your risk tolerance, right? So my risk asset allocation may be different from yours, but I will have still an asset allocation. And let me tell you, as coming from a research guy, a large part of my income or return is generated only because of asset allocation. The sheer fact that I am into equity market will define what is my outcome. Then it will come to what sector I have selected. Then it will finally come to what stocks I have selected, not a vice versa. Unfortunately, most of us are guided by vice versa. I should buy this particular stock, right? And then I go completely all into it and lose money. The third fact of investing is inflation, which is your silent killer. So I was just checking data 2001 to 2000. 25 now. The average annual inflation in India is 6.35%, which means my 10 lakh rupees, which was in 2000, is actually valued 2 lakh 15,000. So almost like 78% of my value is lost. Now I'll tell you another story and which I fell for. So an insurance guy came and told me, if you invest 1 lakh rupees today and you invest 1 lakh rupees every year, for after 20 years, the 20 lakhs will actually give you 50 lakhs, right? Without realizing is actually that 50 lakhs is only 10 lakhs today. I fell for it. I've taken that policy, believe me. Right now, in the hindsight, obviously, I know it was a mistake, but then this is how we all do. 50 lakhs at that point in time was a large sum. But after 20 years, the value is nothing. So please be cognizant that you also need to invest because you want to beat inflation. Another fact, there's one side of wealth creation, the other side is wealth protection. So we have to be cognizant that at what stage we are in. Are we are in a stage of creation or in protection? I am slightly rushing through because of the time. So how do I find right opportunities? The same old principles, focus on fundamentals, not on hearsay, just because some friend told me that buy this stock and with a very good story, very rosy picture, doesn't mean it's a good stock to buy. Circle of competence. I should at least understand the company and its business. For example, I don't understand semiconductor business. Will I buy? No. If I want to, even if I'm very confident that this looks a new story, I will give my money to the experts who manage it, which is a mutual fund in our case. Because if they buy, at least I have the understanding that somebody in their team who is a technology analyst, he will understand what it means, right? That trust I have on my fund manager. Obviously, I have to look at margin of safety and long-term perspective. Uh, Another fact, avoid chasing returns, because if you try to go into chasing returns and because looking at the rear view mirror, the path may be difficult. Leverage, I talked about the wrong side of the leverage. However, there is a positive side of leverage also. And in India, a lot of HNIs are using leverage, but very disciplined manner, in a very, very disciplined manner. So they understand downside, they stress test everything, they avoid concentration, and they leverage only what is relevant, not unmindful leverage. Understanding some little bit of finance. This is very, very, very important. I cannot be ignorant of balance sheet, P&L, what it means, what is corporate governance, what is ESG, right? How the numbers are. It empowers my decision, and this remains with me lifelong, and it helps me in cutting down between noise and fact. The another fact is change in thinking. So there's a book called Rich Dad, Poor Dad, and I'm sure you all have heard about it. So what it says is that is let the money work for you, not you work for money. And he compares his own dad, who was a professor, to his friend's dad, who was compared to a professor was nothing. But his father always thought that the salary that he's getting is the biggest proponent. Uh, and he got those loans and liabilities without realizing these are not my assets, but actually liabilities. So you have to think differently. You have to think about creating assets, creating alternate incomes, understanding that uh, getting high salary is not your asset, right? So that is another. So just to summarize, wealth is a marathon, not a sprint. Start today, stay the course. There are a few couple of slides I'll just run through. So patience like a wise gardener, I've talked about Babylon Time Princess, Rich Dad's asset mindset, behavioral awareness. Must remember it is not created overnight. It is not created overnight. So set your objective, set your asset allocation, create income streams, review, rebalance, and stay disciplined. I will end with this story, small story of three brothers who were having uh, so-called सोने की अंडे देने वाली मुर्गी. So the father gave to all three. The first guy, what he did is spent all eggs quickly on luxuries, right? So it has all given him all the short-term gains. But then when the goose died, his financial struggle continued. The brother two, moderate balance. He saved some, consumed others. But brother three saved and reinvested golden eggs to buy more geese. He created exponential wealth. Now, I leave it to you to choose which one do you want. So again, the slide first I started with, coming back to the same slide, this is the silent approach. Wealth whispers, it does not shout. So with this, I end here. And sorry, I have overshot my time, but there's still time for question answers. I can see a lot of chats. Uh, will certificate be provided? You will give certificate, kindly reply, discipline, patience. Okay, I think a lot of are interested in certificates, but that is okay. So I don't know whether I'll be able to hear you. I think if you guys can hear me, it is good. I'm stopping sharing and I'm all available for question answers. Okay, so there is a quick question. Sir, as I'm a student, we generally get advised not to do investment in portfolio, but in yourself. I want to do both. Please tell me what can be the best perspective. Uh, See, if you can identify, if you are willing to go through that rigor, please do it because you will be saving that extra cost which the fund managers you have to pay to. However, keep the basics things in place. For example, there should be a diversification. So most of the time, the diversification benefits start coming in when you have in excess of 10 or 11 stocks in the portfolio, and up to 35, it matures. So if you have that kind of portfolio, it is good. Otherwise, you are carrying a high concentration risk, which otherwise, when you give it to a mutual fund manager, and I'm not uh, saying that you must, no. Uh, so if you're giving it to a mutual fund portfolio manager, then automatically it gives you a diversification because they own on an average 50 stocks. So that is one, I would say. So so there's no harm in doing it. Do your research, start investing because you will make mistakes, but you will learn. And so making mistakes with a small amount is good, but don't make it with a big one. Should you all be always active in investment or thinking of investment and forget about good things in life? Not at all. In fact, the good things comes with your investments. Let me tell you, it comes with if you see all of our uh, all the names which I talked about, or all the other names which we have seen, or all the fund managers that you have seen. So it's a way of thinking. It's a way of thinking. Whenever they look at things, they critically analyze it, not just these investments, but anything in life. So even if they buy a car, they will critically analyze. Even if they buy gold, even if they buy house, even if they spend in restaurant, everything they will analyze critically because that is the mindset to look at it more critically. And what is enjoyment? See, if you think that spending all money today is the enjoyment, then please do it because I'll tell you that this is the basic economics theory. And it talks about, should I consume my 1 rupee today and get that pleasure, or should I save it for tomorrow and get that pleasure tomorrow? right? So that is a very critical questions, and that different people have different uh, uh, what is a combination of priorities. But having said that, there's a trinity which is very difficult to get it right. So money, time, and health. So in our earlier career, we have time, we have health, but we don't have money. In the mid side, in the mid segment, mid career, we have wealth, we have health, but we don't have time. And at the sunset years, we have time, we have money, but we don't have health. So if you have got the three, you are the best. Okay. Any other question? Sir, I see sometimes when someone's saying I do not invest in securities, I only invest in cryptocurrency. I watched so many videos but did not understand the concept. It is better not to get into. I talked about area of competence. I am not a good guy. I don't understand cryptocurrency. So I don't even advise about it or against it. But what I hear from government, from RBI, from other professors, etc., personally, I am against it. But if you understand it and willing to take uh, measured steps, look at it. But please be sure that you are doing it legally. I have seen people who have done it in a different manner, and I know there's one very close friend of mine. He bought some cryptocurrency, sold it, but because of the rigmarole of the layers of transaction, his account got blocked. So that got into a different. So if you're going with for cryptocurrency, be sure that you are doing it legally. I do not endorse crypto at all. What do you feel how the Sensex will perform for next 10 years? See, I'll tell you very simple logic. So statistically and empirically, we have seen that stock market returns are linked to two things. One is GDP growth, and the second is return on equity by the companies. In the next 10 years, if we are talking about, if not 10 trillion, we are talking about $7 trillion of Indian economy from the current three, we are talking about more than doubling. And ROE in Indian market are in a healthy range of 13 to 14%, which is higher than the cost of capital. So that will also add to it. So if I see from that perspective, I see no reason to be negative on Indian market. So I see it at a growing at a rate of 12 to 13% comfortably. But yes, as I told you, it will bring its own volatility in between, right? So we have reached 4:59. If you have, I am here. I am here. I can take more questions, but I leave it to you guys. Somebody has asked whether I can share the presentation. Yes, this presentation is with the NISM. So I'll request them if they can share it with you. Okay, repeat the words like in the sunset years, health. So I was talking about Trinity. तीन चीजें हैं, health, wealth and money. तो क्या होता है, in the early part of our career, we have health, we have good wealth, a good time also, but we don't have wealth. So I don't enjoy fullest. In the mid career, I have wealth, I have health also, but I don't have time because I'm doing too many things. Again, I miss out on the good things of in the life. And in the sunset years, I have time, I have wealth, but unfortunately, I don't have health. So I again miss out on good things. So if somebody has these three things together at any point in time, I think He is blessed. Inefficient risk management available in Indian is efficient risk management available in Indian capital and commodities market. See, risk management is a mindset. Please understand. No tools will give you a proper risk management. But if you follow simple principles, keep your investments philosophy simple. If you keep it complex, you will make more mistakes. I repeat, if you keep your objectives, philosophies complex, you will make more mistakes. So, what are the simple rules? Have diversified portfolio, have companies which are at least you understand and you have done the basic analysis and you find them at undervalued or at least valued. So, these are the two, three things that you have to keep in mind. If you're doing trading, then you have to be very, very cognizant about the risk management tools because there you're talking about even change of 10 paise will make or break. So it's about a mindset, how you think. If you go to banks, their risk management, their mindset is only risk management. It's as simple as that, right? How inflation and GDP affects Sensex. So, as I told you, the Sensex returns are determined by two things, GDP and ROE. So, and if there are high inflation, so I'll tell you how high inflation impacts. If the inflation is high, then the nominal interest rate is also high. If the nominal interest rates are high, then your CAPM, capital asset pricing model, which calculates weighted average cost of capital, that goes higher. So your discounting factor goes higher. And hence your DCF, discounted cash flow, gives you a lower value. So if the inflation is high, you get a lower value, right? How international wars will cause effect on market. See, international wars, I'm not an expert in that. So, but what we have seen is there are many risks, which I have not talked in this particular session, but there are many risks. And one of the risks is geopolitical risk. So you have to see how much geopolitical risk you are carrying in your investments. So if you're, for example, if my investments are in in stocks which are particularly in Israel in today's context, or in Ukraine, or in Russia, then I'm carrying an extended risk or additional risk in those stocks, right? But if my entire thing is inward looking, then I'm more dependent on domestic consumption, and that is probably a less challenging given the geopolitical risk. So you have to be cognizant. So for example, if I'm on too much on IT sector, and the way US government is curtailing on many visas, etc., then I have a reason to worry, right? They have come out with another policy which says that we will not outsource. So if those are the things, that is my geopolitical risk. Some good books, these are, see, good books, all books are good books. So if you can lay hands on any of the books which is on behavioral finance, I think that is the best. So for example, Thinking Fast and Slow, or if you want to understand more about bubbles, then read this book called Manias, Bubbles and Panic. If you want to read about the value investing, then I think The Intelligent Investor is the best book to start with. There's also a book I have is called uh, ah, I'm forgetting. So there's an almanac which is there. Then I keep on reading actually many books. Even small books like Nudge gives you a lot of understanding. Then see, any books which is on behavioral finance is actually a good teacher than a hardcore finance book. Are you associated with NISM? Yes, I am. I do take. I'm a guest faculty and I take PGP classes there. how can we analyze any MF, slightly detailed topic, uh, but you have to look at a couple of things, how much returns they have, and how they have performed, particularly in bad times. See, when the tide is good, tide is high, all the ships will get lifted. It's only when tide goes down, you will know who is actually doing good, right? Apart from this session, what is your profession? So as I told you, I run a company called Neoble, where I'm trying to build a business. Stock traders. What was the book name? No, no, no. It is not stock trader. The uh, I'll tell you that it's right behind me in the cupboard. Uh, the intelligent investor is. It's a. Give me 1 second. I'll just. So this is called reminiscence of a stock operator. So this is the book I was talking about. It is Neoble, Neoble. So noble with a E in between. I hope you guys enjoyed this session, and do write to me in case you have any questions. Unfortunately, I cannot take all your questions because I know I have already overshot my time. So back to Vishal. So I'll give you my contact number. Connect me on LinkedIn because I don't want to share it right here. So I'll type the name of the book. It is called Reminiscences of a Stock Operator. Over to you, Sahil.
Yeah. So, sir, are we good to end the session?
I think actually there is one Q&A I just missed out. So give me
Okay.
2 minutes. I'll just close on this. Sorry, I missed this Q&A. I was looking at the chat only.
Okay.
Can you please show return slide again, percentage terms of different assets? So basically equity is 12 to 14%. Indian bonds are 6 to 8%. FDs are in the range of 6 to 8%. In fact, 4 to 6% now. Commodities will be slightly higher. Real estate will be 8 to 10%. How to practice discipline, especially in capital market? Yes, it will come with an experience. Initially, it will be very difficult. It is boring. You will be itching to make trades. But how to overcome that? It will come only with experience and when you burn your fingers, both. What percentage of salary to be invested? In fact, the idea is very simple. You have to, uh, uh, in terms of what percentage of your salary to be invested, the thumb rule. I'll give you a very simple thumb rule. If you are not investing so far, then whatever is your age, you should invest that particular percentage from today. So if you are 30 years of age and you have not invested so far or not created any investment, then 30% of your salary should be invested. Now that investment includes, suppose you have already taken housing loan, so that will be part, your PF, PPF will be part, your SIP, right? Because these are all creating assets for you. So if you are 40 and you have not done anything, then you have to mindfully start investing 40%. Otherwise, unless you have a protection for your retirement, your money will be insufficient. Whatever is your salary, because that works beautifully. I've done it mathematically and I found that if I have not done anything, then whatever is my age, I should start from today saving that percentage. Because that is minimum that is required to maintain your lifestyle, given the inflation. So these three questions I have done. Somebody has said very nice session, lot gain. I'm actually thankful for a patient hearing. I hope I've been able to add. My email ID I'll write here, jay.sinha1972 @gmail.com. Thank you.
Yeah.
Thank you,
Thank
everyone.
you. Thank you. Thank you
Thank
so
you.
much, sir. I would like to extend a heartfelt thanks for taking time and speaking at the webinar. Your insight, expertise, and presentation as well truly made a lasting impact on our audience. So thank you so much again, sir, for your time and knowledge.
Most welcome.
Yeah, wishing you a wonderful day.
Okay. Bye. Bye.
Bye bye. Thank you to participants as well for joining us today. Your presence and engagement truly made the session meaningful and impactful. Yeah. Thank you all. Thank you for joining today.